Joining us this morning, Apollo's chief economist, Torsten Slok. Torsten, it is great to have you back because you've been very disciplined about reminding us about the risks that at least that the consumer here faces. And I wonder if you think Macy's comments on delinquencies, for example, this morning is one micro reflection of that.
I do think that's the case. I mean, monetary policy is working exactly as it was intended. When you raise rates, people start falling behind on their payments. This is not only corporates, it's also consumers. So for that, you do and you should expect to see consumer spending begin to slow down as a result of interest rates beginning to hit harder, in particular on households that have run out of savings and also households that generally have higher risks of being more vulnerable to rates going up.
We just had a discussion about if the Fed's not going to do this, maybe the long end will handle it for you. And I wonder if you are sort of concerned about, I don't know, the bond vigilantes, for example. Are they going to create true stumbling blocks, or do you kind of want to have that cop on the beat, given what inflation has done?
Well, the challenge with what's going on, Carl, is that when long rates begin to do the job, it becomes a lot more tricky for the Fed, because the Fed can control short rates. But when long rates now are going up for the reasons that you just spoke to totally about, then, of course, you have a significant risk, including, of course, also that you have that rates are now going up because of the downgrade, because of QT, also because of everything that's going on with yield curve control exit. So the bottom line still is the same, namely that if the Fed is beginning to lose a little bit control here, then the long rates moving up is indeed a little bit more challenging in terms of managing what it means for getting the economy to get that soft landing that we all would like to see.
Interesting. What about the debate over how far the Fed needs to go to really squeeze the economy to get to that 2% target? Do you think that more really needs to be done on that front, or is that target something that could be a little bit more floating, say, toward a 3% inflation?
Well, at least the first observation is that despite this being the fastest rate hike cycle, essentially since World War II, the economy is in incredibly good shape. So one conclusion, at least right off that, is that, well, maybe the Fed funds rate needs to go quite a bit higher. Well, the other way of looking at this is that, well, maybe we should just wait for the lagged effects of rate hikes to come through. And given the Fed doesn't know if the answer is that we need to do a lot more or we just need to wait for the lagged rate hikes, well, then their response has been, and this is likely also what we'll hear on Friday at Jackson Hole, well, to just wait and see. Just status quo is to be hawkish and continue to say, well, we got to see the data slow down. So that process of that slowdown that is in the pipeline continues to be very important for the Fed as they continue to try to get inflation down to the 2% target.
Yeah, speaking of those lag effects, of course, you kind of mentioned earlier in the conversation this idea of consumers running out of their excess savings, the restarting of student loan repayments. Are all of those kind of part of the lag effects that you're expecting to have a real impact on inflation?
Yeah, exactly. And I think that's also why, I mean, if we really think about what the Fed is trying to say, well, they are trying to communicate now that this is the time to begin to pause. What are the arguments for pausing? Well, that they probably worry about that there is more in the pipeline that could begin to drag the economy down. So it's a very delicate balance that they had to walk between inflation still being, in particular core inflation at 4.7, still being too high. And the Atlanta Fed GDP now estimate for this quarter at almost 6% is just incredible. All that would argue for more rate hikes. So why is it that they're not hiking? Well, because they are probably worried about the lagged effects coming through. And given, as you just spoke also with Diane Swonk about, given some of the things that we're seeing with delinquency rates going up on auto loans, delinquency rates going up on credit cards, you're seeing default rates for high yield really start to spike higher in the last 6 months. All those things combined make it quite challenging for the Fed as they try to manage the process here of getting that soft landing.